And for that reason, we really think that our clients need to get a lot more involved than they have been. And we worry even more about clients or investors who don't have an advisor like us, who isn't proactive and who isn't jumping in to do those things. So we wanted to stress to you that we are here for pretty much anything you need. We don't do insurance, but pretty much anything financial that you have a question about, we can handle for you. I want to introduce our team real quick. Amanda Vaught, go ahead and wave. She's going to be talking first today. What you can invest in and what's available to you out there and why you invest in it is changing just about as rapidly as anything else. And Amanda is in Brooklyn, New York today, where COVID has had a major impact. They've been stuck inside for quite a while. I constantly tell her that I don't know how she does it. And she comes from a legal background and a science background, and she does a lot of analyzing. She likes to analyze. And one of the things that she's been very passionate about is, why do we buy these companies anyway? What do they offer us? What are we interested in as investors? And one of those issues is it's sort of generally called social values investing. That doesn't necessarily mean that it's political at all. And we're going to be very, very clear on this call that we're not going to be political. It has to do with, and I'll let Amanda go into it. But anyway, that's what she's going to discuss. David Vaught, if you'll wave, is a retired attorney and our chartered financial analyst. He's in the Chicago suburbs today. Where he is on a day-to-day basis varies. We're very used to working virtually. I've known David for 22 years now. In fact, last week was my anniversary. And one thing I've always liked about David is that he's always been sort of fascinated by the market. It's always been sort of a living, breathing thing for him. He loves to watch patterns and look at historical analysis. And that's sort of what he's going to be focusing on today. In short, there on the screen, we've called it growth portfolios. But the definition of growth, I think, has probably changed more this year than it ever has. And that's something that he's really been following. Watching how our government is addressing it, how private companies have been addressing it, and that's what he's going to talk about today. I'll be up next. I'm an attorney and investment advisor. I'm in East Tennessee, just outside of the Smoky Mountains today, so it's beautiful here right now. And one thing that really struck me this year, now that I'm in over 20 years, is how shocked everybody becomes every time there's this major upset in the market. When I first started in '98, it was just a couple of years later that we had the dot-com bubble burst. Then there was another kind of blip in 2010. Of course, there was 2008, where everybody was affected. It was a major adjustment, and we're going through that again this year. And so I was trying to think about how can we share with our clients and with others how to get ahead of that. It isn't as shocking as it shouldn't be that shocking. This does happen. And my focus really today is going to be on planning and how you can get some of that concern out of your head and on paper and work with us to get ahead of those worries and look forward instead of always constantly reacting to the present. Emily Agosto is our CPA, and she's in Chicago, and she's noticed, obviously she does a lot of tax. Tax advice this year has been a lot different than it has been in recent years. And part of that, again, is legislation. Legislation, again, has been changing very rapidly. And as advisors, is something we have to keep up with as well. So Emily's going to talk today about the different types of benefits there are available to you in this very convoluted legislation system we have, and what you could be looking for, and how you can make it work for you, and how we can help you do that. So again, I've said before, all of us are on, or all of you are on mute. Our advisors are going to stay on mute unless they're talking. And if you have any questions, feel free to raise your hand or send a question over chat, and we'll try to grab it. Sometimes we miss it. You can also text us on our phones. We have them right next to us. We want this to be somewhat interactive. We don't want to just talk at you. We've put in some poll questions along the way. It kind of helps you think. And again, we encourage you to jump in and ask questions and make comments along the way. With that, I'm going to hand off to Amanda to kick it off.
Okay, thanks, Danielle. So as Danielle mentioned, I'm going to be covering social values investing. This is a really big topic. So today I'm just going to cover 15 minutes. So I'll be hitting major highlights and issues involved. So first, I'm going to go through the traditional approach to social values investing, then cover divesting or divestment, and then touch on impact investing, and then finally cover what's called ESG factors, or environmental, social, and governance factors, which is very trendy lately. So first up, the traditional approach, probably many of you are familiar with. That approach is just you make as much money as possible in the stock market or through your investments, and you don't consider your social values in those investments. And then if you do have a social value that's important to you, you donate to charity. So I have pictured here Chuck Feeney. He became well known recently for the Giving Pledge, convincing billionaires to give away money to charities in their lifetimes. So I mean, this is sort of an extreme example of this approach, but everybody can do this as individuals. And later, Danielle is going to be going through financial planning, and if charitable giving is part of your one of your financial goals, we can incorporate that in your financial plan or through your estate plan. Next up, just on divesting. Divesting is what I would think of as a moral choice and not really an investment approach. It's more about, can you sleep at night knowing that you're making profits off this company? And this is a very individual question. You know, some people can, some people just can't. And a lot of people think of divesting as a form of boycott. And so I just wanted to point out that it's not the same thing. So I have here a picture of grapes. So I don't know if any of you remember, in the 80s, there was a large push to boycott grapes to protest how the farmers were being treated and paid. And so what that causes, if you boycott grapes, the grapes are going to go bad. Nobody buys them, and you're hurting the grape farmers' bottom line at the end of the day. But in divesting, you're buying and selling a stock. And so when you have a stock, I mean, that's for sale. It doesn't go bad. It just, the price may or may not change. And if you're trying to sell grape stock, there's somebody out there who is probably going to buy it. So the stock price doesn't really change with this approach. A lot of people do cite the apartheid divestment campaign as being one of the effective divestment campaigns. But divestment is really only effective when it's part of a larger movement or a larger push. So you can divest from South Africa, and you could argue that had some effect, but you could also say that, you know, political action from within the country itself to end apartheid, you know, had more of an effect on changing things there. But lately, there's just more and more investment products that are addressing social values investing. So if whatever your issue is, there is probably an investment product out there that you can buy. So whether or not this is good in terms of social change, like I said before, it's the moral question. Do you not want to profit from this activity, whether or not it makes a change? So I just listed here different issues that you could consider in different investment products. These are things that you could buy that exclude these type of activities. I also just wanted to point out here too that while these are available, they're not generally available in a 401k plan, a 529, or investing type apps. I know later Emily's going to talk about different retirement accounts you can use and the tax consequences. But one thing to consider is different types of accounts can also limit your investment choice. So if this is something that's important to you, you might take the type of account you use for savings into account also. And then just to give an example, a lot of people think that, you know, when you do this type of social values investing, that means that you're sacrificing returns. So I have here on the next slide, just as an example, the Ave Maria group. And this company, I included them. They invest based on Catholic values, and they've also been around for almost 20 years. So you can see here on this graph, I have, I think it's 20 years. I think it's from 2002. The purple line shows you the performance of this Ave Maria fund, and the orange line is the S&P 500. So you can see that even though we're excluding these things and taking social values into account, that doesn't necessarily mean that your performance in the stock market is going to suffer. And then just getting back to my earlier point that divesting is not really a good way to do social change, is we have here what's called a vice fund. And so this is a fund that, for every do-gooder out there, there's, somebody who's like, oh, well, casinos make a lot of money, alcohol makes a lot of money, I'm going to buy stock in that. So this is just an example of other, I guess, anti-social values investing, if you want to look at it that way. And so this also, the purple line is that vice fund, and you can see its performance compared to the S&P 500, the orange line. Okay, and then next up is impact investing. So impact is, instead of thinking of things of divesting, like fossil fuels is an issue that's popular lately. So instead of eliminating your investment in oil companies, you would invest in green technology instead. You're trying to impact a positive social outcome. So impact investing is, I think of it more as a substitute for philanthropy. And you can see here, it sort of falls along a spectrum depending on what kind of impact investing you're doing. Where they show mainstream investing, that's just about making money. Philanthropy is giving all your money away, and impact investing sort of falls somewhere in between. So you can make some money, but in general, it's sort of half investing, half charity in general. And impact investing is generally, for the ultra wealthy or for institutions, but there are more opportunities for smaller investors out there. I give one example here, like kiva.org. That's, you can go on their website, you can pick people trying to start small companies to address poverty, education, that type of thing all over the world. And you can, instead of donating your money, you loan your money. And their minimum is like $25. So anybody can do this. And then also in fixed income, I've been mostly talking about the equity stock portion of your portfolio. Fixed income, bonds, there's a lot of bonds now you can buy that address different social issues. And then just to give some quick examples on the equity side of impact investing, here's one called FAN. They invest in wind energy. You can see this is a recent ETF, so it doesn't have a long history of performance, but you can see it's the purple line is FAN, and the orange line is compared to the broader market. So, it's slightly better performance, but it is a steeper up and down because you are investing in just a smaller segment of the market. And then a final example is the another ETF called SDG. And so SDG is short for the Sustainable Development Goals, which are 17 different goals for sustainable development outlined by the United Nations. And so this is what I think of as sort of a hybrid between impact investing and an investment thesis. Because to do these things like number 9 is grow infrastructure. One of them is to improve clean energy. And the ways that we can go about doing this requires new technology. And this new technology is going to disrupt our investing markets, which becomes an investing opportunity. And then also what things you can find now is just another way to measure performance. So for this example, you can see if you invest in this fund instead of a comparable fund, you're going to lower your carbon emissions by 6%. So they're saying it's not just about the money you're making, it's, look, you saved on carbon emissions. Okay. So next up, I just want to cover ESG. This topic is so huge, I could talk about it for an hour. So I'm going to hopefully not go through it too fast and just hit some of the highlights. So like I said earlier, ESG, that's for environment, social, and governance. So environmental factor considers the companies, if they pollute or not, for example. A social criteria would be, do you give back to the community where you work? A governance factor is, are you taking bribes or not? Are you taking a huge salary while your employees are paid nothing? Are you running the company well? That type of thing. And then if you look at the next slide, I just go through some numbers about ESG. ESG is very trendy recently, as I mentioned. As you can see here, it's approached $1 trillion in assets are invested in ESG funds. So this is just becoming a huge part of the market. And so ESG has been around for a long time, but it's just more recently had this huge inflow of money. And so there's some reasons for that. More recently, it's just the pandemic has brought to light a lot of inequality issues that were maybe always there, but have a spotlight on them now that weren't there before. Europe, there's a big influence there on these UN principles of responsible investing, and the EU also mandates a certain number of ESG investments for institutions there. So in response to that demand, companies are starting to offer more of these products. And then and the final reason is that I think it's up for debate, but mostly the ESG shows better performance than a standard investment typically. So here you can see on the right, these top 1, 2, 3, 4 funds. Those are different ESG ETF or index funds that are offered by BlackRock. And on the bottom is just the standard S&P index. So if you look at the orange line, that's the past year. So every one of these ESG ones has beat just the standard index over the past year. And then the blue is year to date. So all of them beat it except for this one. And then the other thing I just want to cover briefly is I've been giving just now examples of what's called passive or an index ETF. With ESG, this can be a questionable approach. I mean, it does work to some extent, but you have to look under the hood, I think. So if we say, okay, ESG, where is this data coming from? How are they determining what's an ESG factor and what's a good ESG factor? This is very subjective. The ESG data is not a required disclosure from the SEC, and recently the SEC commissioner said she's not going to make it one. So what people do is they generally rely on Morningstar or the MSCI Morgan Stanley group to compile data from different sources about different companies and evaluate them that way. And then these companies give each company a score from like 1 to 100. So some really, wind-powered, great governing, great social contributing thing with 100, a poor performer, polluter, awful company would be, a 0. And then some people, because ESG is often lumped together with social values investing, and there is some crossover there, some people think that because it's ESG, that means it's some type of green product. But I just give a quick example here of the ETF from the earlier page, SUSL. This is what they typically do is they'll take, say, a universe of stocks, like the 500 stocks in the S&P 500, and they'll say, okay, we'll take every fossil fuel company in this sector, and we'll say, oh, okay, we're going to take the top ESG ones. So they'll take, say there's 100 energy companies in the S&P 500. They'll say, okay, these 75 has the best scores. We'll eliminate these bottom 25 from our index, and those top 75 are the ones that are included. So even though this is called an ESG fund and you think, oh, environment, it must be some green thing. It's really not. So I just pulled this from their website. These are all the fossil fuel companies that are included in this ETF.
Amanda, did you see Leslie's question?
No, sorry.
Okay, she asked if ESG offers a rating of investments.
Well, they're not rating the underlying investment per se, like the quality of the company. They're just looking at the different factors. So if it's, I don't know, the Clorox company and they, they make bleach, and is that going to pollute Lake Michigan, for example. They'll say, oh, maybe they're going to pollute. Oh, okay, their environmental score might not be so good. Oh, but oh, look, they're doing some kind of treatment before they let their chemicals out of their plant. Oh, so that would improve their environmental score. So then that would give them a higher rating in terms of an ESG level, but not necessarily whether or not Clorox is a good company to invest in.
Does that answer your question, Leslie?
I'll just get to my next slide really quick because I'm running out of time. But this is just a quick example of a different approach. This is a mutual fund, which is an active approach. So this is Parnassus Investments. That's the purple line. I included their performance from the past 10 years compared to the S&P 500, just so you could get an idea. So they take sort of a combined social values and ESG approach. So they first divest from fossil fuels, eliminate those companies completely. Then of the companies that are left, they identify quality companies that they think are worth investing. And then after that, they do their research and figure out what ESG factors are important that they think will help these companies succeed in the future. And they apply that filter sort of over those companies and then pick the best companies based on that ESG lens, I would say. Okay, and then next up, I just want to do a poll just to get an idea of the people who are here today, what you think about social values, if this is something you're interested in incorporating into your portfolio or not. And I thought Zoom would automatically pop up the poll, but maybe I...
on it. Okay, here it comes.
Oh, okay. Thanks, Emily.
Is it up? Yes.
I don't see it on my screen, but I'm not an attendee, so...
I can see it. You can't.
Yeah, I see it. It's up there.
Oh,
Okay. I know last time we had our seminar in June, there were some panelists who couldn't see it. So
I set this poll up. You can pick more than one if more than one of these interests you. I was just curious to see what people thought. Because like I said, everybody's different. For some people, this is an important thing. For some people, it's, you know, the traditional approach.
oh no, see, Erin didn't get the poll pop up. Yeah, we had this happen before. I don't know why.
Something.
I don't know what it is. I don't know if it has anything to do with the whatever web browser you're on. I don't know.
Yeah, maybe if you have a pop-up blocker, I think it doesn't work.
Oh, that's possible. Yeah. Oh, yeah, that's what Aaron said. It might be because he's on a browser version. Can we go back really quick to that? I know we're eating up time, but can we go back really quick to that Parnassus slide?
Yeah, let me end this poll here.
Oh, sorry.
Okay.
And I just wanted to say that Parnassus is one of those funds that we're actually using in all of our portfolios. I mean, this is one that we're using. Amanda was great about showing some examples of things we've never even heard of, so we're not necessarily using them. And we don't get paid anything from these companies, but this is one that we did research on and liked, and we're really using it as an alternative to part of the S&P 500. And you can see that even this year, with as crazy as it's been, it's comparable to the S&P 500. So why not buy some of that instead of the S&P 500? So anyway, that was all I wanted to add to that. But thanks, Amanda.
Yeah.
Yeah, I just want to add, Danielle, I know when we did the conference call with them a few weeks ago, a lot of these active, not just Parnassus, but some other actively managed mutual funds are really working these factors into their risk analysis. Oh, if you consider that and Parnassus totally avoids fossil fuels, and they consider those a risk. You know, they think that, you know, fossil fuels may go away. This may not be a good place to invest long term because they may face huge disruption as other forms of energy take over. You know, looking at it from just a risk point of view is another way of looking at it. It may not apply to all the factors, but it certainly applies to some. So It's working its way in, whether or not the SEC wants to list it as an official factor or not. When people are actually working on what to buy, they're paying more and more attention to this.
Yeah, and I think it's something that, I mean, depending, it's really an individual choice too. And you can, I mean, I think you're right about the ESG, but it's also something that you can make, 1% of your portfolio or 100%. It's not like an all or nothing thing. But I don't know, I can't see the poll results, but I think we need to kick it over to David, who's going to talk more about different things you can put in your portfolio.
Yeah, we were able to see poll results before. I don't know what happened. Emily, are you able to see that or no? No? Okay.
Okay, well, Amanda, thanks for that. That it's something that I think we're all learning more about, and can have a good effect on portfolios. Our June webinar, we talked about two approaches trying to get at the question, well, what do we do now based on the changes we've seen in the economy and the markets already this year, related to the pandemic, but related to other factors that link to the bull market that preceded the situation we're in today. When you have a long bull market, the last 10 years, it's eventually going to end. So we contrasted a conservative equity approach that focuses on reinvestment of profits. If these companies and their managers do a good job of reinvesting their profits, that compounding that creates can be a very important factor. That's generally associated with the value style of investment. And then we contrasted that with a more aggressive growth approach, which is more future oriented. So we're doing whole portfolios. We're looking at the investment management process as objective to people's goals and objectives by looking at how does their portfolio do that. You can look at it one stock at a time if you want, but we really think it's much more productive to have a portfolio approach. The individual securities and what happens in them, I'm getting this screen here.
Mm-hmm.
Is it on everybody's screen?
Yeah, I can see it. There you go.
Yeah, got it off. We think that by structuring an entire portfolio, you can do a lot better job of managing risk and meeting those objectives. What happens in individual companies drives all that. It tells you what's going on in the economy. It tells you where money is being made. It tells you, what kind of companies these are that are in various mutual funds and ETFs. But really think that diversification and the sustainable approach it's much stronger. So we're thinking of this in portfolio terms. What I'm trying to say in a few words that I said in too many. These are the classic definitions on the screen of growth stocks and value stocks. They're pretty simple definitions. These come directly from Investopedia. But the growth stocks are the ones that have the potential to outperform the market because of their future potential. What's going to happen out there in 3, 5, or 10 years that affects their revenues, their profits, their market share, and are they going to advance quickly because of that? Those are growth stocks like Amazon. The value stocks are ones that are, when you analyze the company and its cash flows and its profits and its dividends, they're really trading below what they're really worth. So this involves a lot of financial analysis of really what the business is worth as opposed to what the stock is worth. And value stocks are those that are trading below what they're really worth. And therefore, over time, they're going to recover and provide a more superior return. Now, we have made, since that seminar in June, some changes and additions in portfolios. And basically, what we've been doing is increasing the growth part of our portfolios. That adds innovative solutions in disruptive industries. It takes advantage of market changes. And when you look at our all the portfolios we have, all the securities we have for all clients at the end of the second quarter, back when we were being a little more conservative, our value to growth ratio showed us favoring value over growth stocks by a ratio of about 1.1 to 1. In other words, 10% more value than growth. We've shifted that over the last quarter after the long bull market ended and we've had these economic changes. And now when you look at all the investments we have for all our clients, our growth value ratio is 1.12. In other words, we're about 12% more growth than value in rough terms. And these growth investments so far have been doing well. The other investment idea that drives our selection of investments is the idea that a well-managed active mutual fund or ETF can outperform the market cap weighted index funds. Now, we use index funds for their low cost and to get broad penetration into the market. It's not like we're opposed to them. But there's a lot of sales talk out there that's really misleading people today that says that the index always beats all the active managers. Well, actually, if you listen a little more carefully, what they're saying is that very often, especially in some sectors of the market, index funds beat the average mutual fund. But we're not trying to invest in the average mutual fund, folks. We're trying to invest in the better mutual funds. And so if you look at this question, that what happens when you're in a top quartile mutual fund, actively managed mutual fund, over a long, consistent history, what happens when you invest in those kind of mutual funds compared to the index? We've had pretty good success in that area, especially in the international area. It's a lot easier in the international area, really, to find a higher quality mutual funds, among the broad range of investments that are available there, including lots of risky stocks and lots of companies aren't doing very well in the international world for various reasons. But skillful avoidance of those negative factors out there that in the index, suppose every stock is in the index, is part of what happens. We did this little hypothetical illustration over the last 15 years. What if you took an above average, a really good growth large cap mutual fund and a really good above average value active mutual fund, and you put them together 50-50 and you rebalanced every quarter. In other words, when the growth fund did better and went up to 52% of your total, you sell 2% and put it back in the value and come back to 50-50. That sort of disciplined rebalancing has generally been shown in most academic studies and in practice to help performance over time. You stay on your target, and it forces you to take profits when you've got profits, and instead of just trying to keep riding with what's doing well. So that analysis involved a couple of funds. We've mentioned them here in the footnote. One is from T. Rowe Price, their New America Growth Fund. That's the growth fund. And from J.P. Morgan, their Equity Income Fund. Those are both funds that we invest in, although we haven't been investing in all of them for 15 years. But in this hypothetical example, you can see the results. And you can see that in every period, the actively managed 50-50 approach beats the S&P 500 all the time. And even in short periods of time, but also in the long periods of time, out in 5, 10, and 15 years. Now, what's important about that is not that we could find a couple really good mutual funds to do that. You know, you could do it wrong and find some mutual funds that didn't do that too. But why is it that can happen? And why does it happen? The key, or one of the keys, is both these funds avoided those bottom performers in the S&P 500. If the S&P 500 is doing really well with its very top holdings, but it's got 150 dogs in the S&P 500 index, then when you buy that index, you're buying those dogs too. So one of the things that these active managers do, just avoid those poor companies. And so they may not have 500 stocks. They probably usually don't have 500 stocks in their portfolios. They have a smaller number that tries to avoid weak companies. I've already mentioned the rebalancing. That's another thing that happens even within those mutual funds. is they'll rebalance when one of their stocks does very well. We've got a fund that buys a lot of Tesla, and they buy more than a lot of funds buy of Tesla. They go up to 10% of their fund in Tesla, but Tesla has been going through the roof, and so they sell it when it goes above 10%. They rebalance down within their own fund. And the other thing that active managers do, and they do a good job, is that they skillfully pick the positive companies as well. So it is possible to do that. And I think it's important for our investors, the people working for us, to know that we like to do a combination of both. We like to do some index funds where they're low cost and to get you well diversified and representative in the market. And we try to enhance return by adding these stronger actively managed funds. I think we have a poll too, don't we, Emily? Here it is worded. I'm not seeing the poll version. Is that going to come up, or are we going to have some people get an ability to make a selection? There. This just asked you about your preferences. You know, some people like a lot of individual stocks because they like the news and the good name here in the media. We try to do a lot of portfolios that match people's objectives and limitations. Some people are big delegators. They don't want to have to worry about it. They don't want to bother with it, and they really want to delegate the whole composition of that portfolio to an investment advisor like our firm. And some people want to be more safe. They just want to don't lose any money. Buy me more bonds and safe investments I don't want to lose. So if you could indicate your preference, and we didn't get the results last time. Emily, do you think there's a way to get the results when everybody's finished?
Yeah, and can you hear me okay?
Yeah.
Okay, sorry for my technical difficulties. Yeah, that first poll was about 70% people were most concerned about the environment. And then I think Amanda can launch the results of this poll when they're in.
Yeah, it's been about a minute, so we've had most people voted. So I'm just going to go ahead and end the poll and share the results.
Okay.
Can you see this? See them? Okay.
That's a good. I like that result. You know, I think that emphasis that among the winner is to have a portfolio designed to match your objectives and limitations is very important. We certainly try to do that, because we don't think cookie cutter portfolios are sort of like one size fits all. If you're 40 years old, this is the kind of portfolio you ought to have. We don't like that approach. We like to understand what our clients think, what their concerns are, what their objectives are, and then try to apply that to how do we construct portfolios. And then we've got a lot of delegators in there too, which, you know, some people have trouble with that. They're concerned they're losing control. We think if you monitor it correctly and pay attention to what's going on, you're not losing control at all. You actually may get better control just by having help that you need. So we're glad to see those results. I think they're pretty interesting ones. I've got one other fund I want to mention. And I didn't comment on the Grand Canyon picture. Everybody cautioned me I shouldn't start talking about the Grand Canyon or we'd go way over. But over on the left, Eric and I hiked that trail down there, that Bright Angel Trail. You see that little green down there that looks a little ways off. That's the Bright Angel Creek, and that's the way the trail is set up if you want to hike from the bottom of the Grand Canyon up to the South Rim. We did them both, North Rim to South Rim. That prior picture that I didn't comment on was Rainbow Falls down in the bottom of the canyon after we had hiked about 10 miles into the heat. And that falls created a mist that was like being in air conditioning in a nice office. It was really cool, even though you were in 100-degree heat over in the canyon not far away. So anyway, that's why I stuck these pictures there, because I like being reminded of that. That was really fun. In addition, we added and talked about last time ARC Innovation in the June seminar or webinar. And that's available still on YouTube. If some of you didn't participate in that or would like to see that, or go back and see if we said similar things or made sense back then as well as today. But in addition to that fund that we added Wasatch here, Small Cap Growth. we would have loved to add Wasatch a long time ago, but it was closed. This happens to small cap funds a lot. You know, there's only so many small cap stocks out there. And so when a fund manager does really good, money just flows in like, like a nice summer rain. And they get more money than they can really handle because, after you've got too much money, all of a sudden there's no more small cap stocks you want to buy, and they start buying larger cap stocks and mid cap stocks, and they they drift off their original style and what originally made them very successful. So good managers will close that down and say, this is all the money we can handle to do what we do. No more money can come in. No new investors can come in. What Wasatch did is very briefly in this market retreat earlier in the year say, we can handle a little bit more money. We're going to reopen our fund. And so we talked to them. We did our due diligence as quickly as we could, and we invested there. And so now we're on the list. We can add new investors to this investment as well, even though they reclosed the fund. But investment management firms like ours, if you get established with a mutual fund company, even when they close the fund, they will generally let their existing investors keep adding to the fund, or an investment advisor add new people to the fund. So we were very happy to be able to get in there. You can see this is a real winner and has been for a long time. Their index that most closely follows what they do in buying small growth stocks, which is represented by the Russell Growth Index. You can see its long-term performance, 1, 3, 5, and 10 years, and look at those excesses that Wasatch was able to achieve. Generally 2 or 3, sometimes double. They've doubled the index in the 5-year period and in the 3-year period, and more than doubled in the most recent 1-year period. But even over the longer 10-year period, they're greatly exceeding it. So we think that that's a really good fund, and we're happy to have added it to a number of portfolios. Just as a little update on some of the things we're doing is we shift to more of a growth index in our, more of a growth overweight or tilt in our portfolios. So that's what I've got. And Danielle, I don't think I talked too long about the Grand Canyon. But,
Well, I'm going to have to cut some of mine out. It's 4:17, and if you're going to be respectful of the audience's time, it's over in 13 minutes. So I am going to do my best.
You're saying I did talk too much about it.
So I may just kind of say skip, but go ahead and go to the first slide. When I was sitting down thinking about how I wanted to talk about this, and I said sort of in the beginning that I think people need a more a plan. I mean, I talked to plenty of people who don't even have a budget. So I know this is a hard sell sometimes. We all do our own plans within our firm, and I'm not going to read all these statements because I don't have the time at this point, but I think a lot of people feel that, and maybe it's true because a lot of firms don't spend the time with their clients that we are willing to do, but we think that a formal plan is important for everybody. And I'll just go ahead and skip this page and go to the next one for now. I want to talk about a financial plan document. In case you're wondering what I'm doing in that picture, I'm throwing a coin behind my back in Rome to the Trevi Fountain to plan to go back to Rome. So that was the point of that picture. But a plan document is what it says it is. It's a document, but, and I think it sounds dry, like I just am going to make a list of stuff, but you're really not. It's more of a conversation. And we're going to make lists. We're going to make lists of your current and future assets, what your debt looks like, what it might look like in the future, what your financial goals are. We're going to talk a lot about risk tolerance, which we already do when we manage portfolios. But we're also going to talk about things like priorities, needs versus wants, which sometimes sounds like it's cut and dry. But then once you start talking and I start asking you annoying questions, you start going, I don't know, maybe not. We talk a lot about expectations, concerns, and those personal goals, again, about where you want to be in the future. I mean, retirement for most people nowadays doesn't mean you stop working. A lot of people still work. It just looks different than it did before, retirement. And the heart of the plan really gets into what ifs. What if I live to be 95? What if I live to be only 70? What if my health is great and I die peacefully in my sleep and have to pay for myself for the next 30 years. So we run different scenarios, and they don't all have to be retirement. I mean, a lot of them are, but they can be something as simple as I want to be mortgage free in the next 10 years, or I want to pay for my kids' college or whatever. They also talk about market behavior. One of the great things the software offers us is, what if 2008 happened again next year? Or what if it doesn't happen for another 10 years? I mean, that's going to have a really big impact on what your plan looks like and what you're able to do. So we also talk about how that looks in future terms for future money. And in the next slide, I'm just going to go through really quick. That's my son, 2 feet from the edge of the Grand Canyon. So I titled this slide, "What are you worried about?" And that's just I made up just a pretend person. I called her Responsible Jones, and I made up a financial plan, and it's on our website with the blog posts that I wrote that we just posted today on our site. So you can actually see what a plan looks like, and I just grabbed a few pages out of it, but you can see that Miss Jones intends to work part-time for a few years. She wants an active lifestyle, time with family and friends, and travel. And her highest concerns are running out of money because she thinks she's going to live a long life. So again, there's a really long stretch of the time in the planning where it's just the conversation about what you want your life to look like, or what you think it might look like. On the next slide, we do a risk assessment as far as investments. Whenever I have questions for people, one of my favorite examples is I met with a client and they were like, "Oh, I don't want any risk. I'm very afraid of losing my money." And then I looked at their portfolio and all they had was like 10 individual stocks. By our definition, that is extremely risky. So sometimes we have to have these pretty lengthy conversations about what risk really means to the client, because the word is sort of nebulous. And we're going to talk about what makes sense for you to invest in to get to the goals that you have, and also to make sure that your heart stays in rhythm. We don't want to create a portfolio for somebody that they can't sleep at night over. So we have that conversation a lot. I think that I end up doing, personally, some sort of we kind of meet in the middle sometimes with clients. We start off maybe somewhere else and we talk and get through it to a point where we're both comfortable, where I feel like the client is going to get what they need and the client feels like they can handle the volatility that may be there. So the program, when we run these financial plans, will actually give us, like this example here is showing what happened to this particular portfolio in 2008, and it was down 33%. Now, back then, Responsible was in her 30s, so she could handle that. That was no big deal for her. Now, if you're 60s and 70s, you probably can't handle that. And if you can, it's because you have a lot of assets elsewhere. And anyway, like David said, these are all very individual discussions. And that's the great thing about the plan. It's based entirely on you. And the next slide, we talked a little bit about this already. How you invest your money has an important impact on your future money. And in David's poll, he said that he gave you the option of choosing just to be in bonds because I don't want to lose money. And I hear clients say that all the time, I don't want to lose money. And by that definition, they usually mean, I don't want the money that I gave you when I started this portfolio, whether I was 22 or 45 or whatever, I don't want that amount to go down. But we also think as financial advisors, when you don't take the risk that you should be taking, you're still losing money. So for instance, that we had a couple clients who really freaked out in 2008 and sold all of their stocks at the bottom of the market, went to short-term bonds, and stayed there for at least the next 5 years until they felt confident that the market was going to be okay. And they lost a ton of money doing that. There was a lot of money that they literally lost. They dropped it, they sold it, it was gone, and they couldn't get it back. So there are different definitions of losing money, and that's something that we have to remind clients of sometimes when they're stressed during negative periods in the market, like March of 2020. And so part of this plan will show you a success, a percentage of success. You see that little half moon on the left there that says 97%. This particular client, based on what she has and what she wants to achieve, there's a 97% success rate. If we do a portfolio plan for you and it says you have a 60% chance of success, we probably need to make some changes. And I find that very helpful. Again, we do all this in-house as well. Next slide. A complete financial plan includes the financial plan document, but it also includes estate planning. Too many people tell me that they don't need a will because everything's going to go to their family. And sometimes that's true if you've done a lot of estate planning, but a lot of times it's not. And so we talk about the kinds of documents that you should have. And lastly, tax planning. Taxes are a huge issue for everyone, whether they pay a lot of it in or not. And it's something that people just don't spend the time to plan for. Taxes have gotten insanely difficult, and you can estimate for them. We do recommend it. We do it a lot with people. And the other part of tax planning is the strategic use of accounts, and that's what Emily's going to talk about next. So I think I did that pretty good. Oh, and sorry, here's my, really quick. David and I talked a lot about what a definition of tax efficiency is. Some people think that means simply paying less tax, and we argue that it's not. It's proactive. It means saving money, or maybe paying some tax now and compounding your investments later, taking advantage of all those legal options, which again, Emily's going to talk about some more, and acknowledging that we don't know what's going to happen in the future and try to get our minds wrapped around how we're going to handle different things as they happen. Can we pop that poll up really fast? There we go. So I just put up a poll. When it comes to a financial plan, I am blank. And while everybody answers that, Emily's going to really focus on, as quickly as she can now, the different types of savings plans that people have, and the most common ones that we recommend and why.
Okay. Are we moving on? All right, here we go. Okay, so I'm going to talk a bit about retirement savings accounts. There's so many different types, and here's just the 4 main types of retirement accounts that people are probably, you either have or you're at least familiar with them. Several years ago, Danielle came up with this analogy for your retirement accounts. If you think of them as like different cookie jars that you can draw from at retirement, and I really like that idea, so I'm stealing it from her. And yeah, it's just this idea that you have various different vessels to contribute to so that you can maximize your tax efficiency. And there's the results of the poll there. If you guys want to take a look, I voted for that same one. That is 50%, missing some significant pieces, so something I certainly need to work on. Okay, so let's move on to the next slide here. Okay, a question we get a ton is my 401k the best place to invest? And that answer depends. It depends on, does your employer offer a match? Are the investment vehicles in your plan limited? Things of that nature. If you're getting a match from your employer, by all means, contribute as much as you need to in order to get that match or in order to maximize that match. It's free money. So of course, we're gonna say go for it. But in terms of 401k plans or employer plans in general, they vary greatly, and most of them do not have an option to invest in anything you want. We recently learned last year about self-directed plans. There's one specifically through Fidelity called the brokerage link. If your plan is through Fidelity, maybe ask your employer if that's an option, or there probably exists a similar plan at all different kinds of banks. But yeah, so the answer is maybe. Let's switch, let's skip over this, as I'll get to this on another slide. And skip one more, please. Thank you. Okay, so I'm going to talk about 4 kind of tools and strategies to think about when you are choosing your retirement plans. So RMDs, if you're not familiar with them, it's your required minimum distributions that you need to take out of your retirement funds when you reach age 72. It used to be 70 and a half, but the Secure Act of December 2019 increased that age to 72. The required minimum distribution is a calculation. It's just a standard calculation based on how much money is in your account. So the larger your account, the larger your RMD is going to be. And this is an important point because we get this question also, do your retirement distributions affect Medicare or Social Security? And the answer is yes. So distributions from tax-deferred retirement accounts increase your income, which increase your AGI, your adjusted gross income, which the AGI is used to determine the cost of your Medicare Part B premiums. So the higher your AGI, the higher your Medicare Part B premiums will be. And this can also have an effect on Social Security. If you're receiving Social Security and you're still working at age 72 and you have income coming in, the higher likelihood that your Social Security will start to be taxed. Okay, the next concept is inheritances. And this is a topic that's gotten a lot more confusing, I guess, after the Secure Act that passed back in December of 2019. The main change is that it's accelerated the time in which distributions are required to be taken out of inherited IRAs, and when the inheritee is a non-spouse individual. So it really accelerated the time that people need to pay taxes on these distributions. It limited it to 10 years after the date of the death of the beneficiary, I believe, instead of being able to spread out these distributions over the life of the beneficiary. Okay, and then
and beyond. I mean, they could leave money to their kids too, and now they can't.
Exactly, thank you. What if charitable giving is a priority? And we already talked a little bit about this earlier in different aspects, but the QCD is not so much new, but it's a helpful tool that we're seeing utilized more and more. It's a simple way to reduce your taxable income while also contributing to a cause that's important to you. Okay, just got a couple more points I want to make. Planning for uncertainty. So obviously we plan for times of uncertainty, and this year certainly demonstrated, some strange and uncertain times. So we get this question a lot as well. What if I need to access my funds before retirement age? So the Roth IRA, you can withdraw your contributions without penalty before age 59 and a half. It's the earnings that would cause an early distribution penalty. So another option that we're recommending more and more is to keep money in a taxable savings account. So instead of your traditional retirement accounts that you can't touch for a while, this is a good strategy to keep your funds more accessible and more liquid to you. And then in terms of taxes, when you have any taxable gains, those capital gains rates are only 15%, and that's as opposed to paying income taxes on full distributions, which on average, majority of people, income tax rates can be anywhere from 22 to 32%. Finally, I just want to talk about the Roth conversion. It's an excellent tool to use. You can convert all or part of the money in a traditional IRA into a Roth IRA. So even if your income exceeds the limits for making contributions to a Roth IRA, you can still do a Roth conversion, which is sometimes called a backdoor Roth. You might have heard of that. And even if you can contribute directly to a Roth IRA, you may have a significantly higher amount of savings in a traditional Roth IRA, and you just want to balance out those cookie jars, and be able to have some more tax efficiency across the board, I suppose. Actually, do I have one more slide? No, that's it. Okay.
I think you didn't get really a chance to say that the reason we like Roth so much is because you put the money in now and you don't save anything now, but all that money grows tax-free forever, and it doesn't have to be taken out, and it doesn't show up on your tax return. So when you have a year where you are still working, for instance, but you need to dip into something, you can get into that Roth and it won't impact, again, we're kind of rushed now, but Medicare Part B plans are based on your income. Healthcare.gov insurance plans are based on your income. So Roth conversions are great because when you take Roth amounts are great because when you take those monies out, it's invisible on your tax return, which can save you a ton of money and create some flexibility where there wasn't any before.
Yes, thank you. And also regarding Roth conversions, don't go run to the bank and do it right away. You definitely want to plan, make sure you're not bumping yourself up into a new tax bracket. Now's a great time to do tax planning. It's the end of September, thank goodness, but also, wow, that year flew fast. So go ahead and let's take a look at this final poll. Which types of retirement accounts do you have? We're just curious. You can select multiple accounts. And yeah, I think we're just going to wrap it up. Thanks for bearing with us. If you have any questions, we'll stay on here for a little while longer, I think.
We do have a survey at the end for once the webinar closes. If you have a minute to give us feedback on our presentation, we'd really appreciate it. And I
Is
have
any-
a Roth and a traditional IRA and a taxable account.
Me too. Yeah. Oh, thanks, Edie. Does anybody have any questions that we can either, if a lot of people come off, we can put you off mute, you can see, or we can just, you can send them on chat too. Hey, that's a lot of Roth IRAs. I'm happy to see that.
Getting ready to say that, Danielle. You beat me to your mute button.
Only because of you, Danielle.
That's really pretty positive. We've been talking about that a long time, and it looks like a lot of people have figured it out or listened to us. Which they got it done.
All right. Gosh, everybody's quiet today. No questions? You're sending questions, I'm not getting them. Oh, Bob sent one.
Do you see his question? Okay.
Yeah. Bob asks, if you can't see it, is there a new standard for emergency cash to have on hand? I'm happy to talk unless somebody else wants to answer that question. When I sit down with somebody and ask about their emergency cash, I usually call it their cash cushion. And I say, I like to have 2 months of your expenses in cash, like online or in your savings account or your checking account. And beyond that, I would love for you to have at least 6 months of expenses in liquid savings, meaning some of that cash is in your savings account where it's not invested in anything. And right now it's not making anything either, but the rest of the money that you save up can be in a taxable investment account where you can invest in bonds and stocks and hang on to it for a while. And then you'll actually get something for that money. Like Emily said, we're actually recommending taxable accounts more and more now because of the Secure Act, which she didn't get to go through as in depth as we would have liked, but it's basically become almost like an estate planning hit for the middle class. And tax deferred vehicles like IRAs and 401ks, unless you're getting that free money on a match through your employer, is much less tax efficient than it once was. And I think that Roth IRAs, having now been around for 20 years as of last year, it's becoming obvious how beneficial they are. And taxable investments are the same way. You put $1,000 into a taxable investment and it becomes $2,000 when you sell it. You probably only pay 15% on $1,000. If you put $1,000 into your IRA and it grows to $2,000 and you take it out, now you have to pay taxes at your regular income tax rate on $2,000. So by definition, you are paying more tax. So to quickly answer Bob's question, I usually tell people 2 months of expenses in cash and at least up to 6 in their taxable investments, but I'm also increasing my taxable investments to include retirement investments or just future needs that way.
We also have a couple questions in the chat box. Kathy says, would you pull out Roth funds first, then a regular IRA later, or vice versa?
For me, that depends on the client and the year that they're dealing with. I had an issue like this not too long ago, in fact, and the client didn't want to pay any taxes, but they didn't want to take down all their Roth IRA money, and they needed to take a chunk of money out, and we took it from all 3 places. And so it just depended on how much they were comfortable paying in tax and how much they could stomach taking out of the Roth IRA. And so we just did sort of a balancing act. So the answer to that question really depends on a number of factors, but that's one of the things we take the time to figure out. I know that wasn't a perfect answer. How Kathy was happy with it anyway. And,
I want to add to that a little bit, Danielle, because I think that we're trying to achieve a little different balances based on some of these changes in the tax laws that Danielle's referred to. So how you balance those three is important, but also the time horizon is important. If you're going to have that Roth for a long time or a longer period of time, go ahead and pull it out of your regular IRA. Let that Roth keep building up, because that long-term benefit of that compounding in the Roth that you never have to pay taxes on is just worth more over the long period of time.
And did you see this question from Colton about the difference between traditional and Roth?
Yeah.
I touched on it a little now, but.
Yeah, so I'm trying to put it as simply as I can. A traditional IRA means that the earnings, at least the earnings, and sometimes the contributions, are tax deferred. And that does not mean tax free. It just means that you're not paying taxes on it now. You pay taxes on it when you withdraw the money. And for some people, that is many, 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 many years. And during those many, 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 many years, the money has grown significantly. So like I mentioned earlier, you're now paying regular income tax rates on all of your earnings, whereas in a taxable account, for instance, you're just paying taxes on the realized gains at a lower rate. Roth IRAs are, you put the money in now, you don't get a benefit. You know, if for those of you who have a 401k, a traditional 401k, you like it because you're like, well, I'll max out my 401k and I'll save the taxes on that contribution. And that's great for this year. But if that amount of money that you put in, for instance, if you put $19,500 in, which is the maximum this year if you're under the age of 50, and that $19,500 becomes $50,000 by the time you retire, and you're in a 20% tax bracket when you retire, then you're paying $10,000 of tax on that versus the $4,000 you paid when you put the money in. So Roth IRAs are completely different in that you don't get any tax benefit now. You make money, you get a paycheck, that money's been taxed by the government, especially if you're young. If you're young, I'm like, put as much money in there as you can. If you're in a low tax bracket, it is a no-brainer. If you happen to be in a 10 or 12% bracket, you max out that Roth IRA if you can, because you are never paying tax on it again. So if you put $6,000 into your Roth IRA, which is the maximum in 2020 if you're under the age of 50, and that $6,000 becomes, $32,000 someday, you don't pay a dime on the $26,000 that you earned on it. And it doesn't show up on your tax return. Did that help, Colton? And I explain that probably 3 times a week. Like it's one that we really push on. Okay, thanks.
Yeah. Okay, I think that's all of our questions that we got on the chat. If anybody has any other questions, you are always, please call us, email.
Thanks, Leslie.
I'll put our contact info here for everyone.
And then when is that last poll coming up? Does that come
The
up
last
now?
one will come up when I close out of the webinar. So.
Oh, okay. So hang on for a second. You'll get one more poll there at the end. And if you need anything, just reach out. We're always available. Thank you so much for coming. This was a really good turnout. I'm really happy.
Yeah, thanks everybody. We're glad
Thank you.
to hear from you all and get chats and questions.
Thanks, Scott.